Good afternoon, folks. Thank you so much for joining us on the passive. What is the name of our show now? Passive Accredited Investor Show, not to be confused with the passive aggressive show. Anyway, we discussed on several shows ago some of the repositioning that had to happen during COVID of different commercial assets. And we want to give you the other side of this now that we've kind of worked our way through it. And we'll do so right after this. Again, it's Bill and Wendy holding down the fort. Thanks
and this
again.
Is not a fake background.
That's right. You can tell because the snowbirds next door have their shields up across their windows.
That's right.
You don't usually see that in most paradise pictures, right?
That's right.
But they won't be back for hurricane season, so they're passive.
So
thanks for joining us on the Passive Accredited Investor Show. We are Carolina Capital Management. We make loans to real estate investors in the Southeast. So if you are interested in borrowing money, go to carolinahardmoney.com. Click on the Apply Now tab. If you're a passive investor looking for passive returns, then click on the Accredited Investor tab. Don't forget to like, and subscribe. Hit the bell. And lastly, but most importantly, don't forget to sign up for Wednesday with Wendy.
That's right.
Okay, so yeah, we're still working on the graphics and when I'm supposed to be introducing them. Anyway,
well, you're supposed to use some hand motions when you do that. Remember?
Okay.
We talked about that.
We did.
Well,
okay, so here's the link to Wendy's calendar. She donates 1 day a week to talk to any person that wants to talk about anything real estate related. Actually, she'll talk to you about anything, but you're wasting your time if you don't talk to her about real estate.
I don't know about that.
That link will be over in the chat side. And that reminds me, we do have a question chat section to the right-hand side of the screen or underneath, depending on the platform you're joining us from. So ask any question or make a comment, and we'll do our best to answer it for you. So Wendy has changed locations, as you can see.
I walked outside.
You need to get over there and cut back on that vine. It looks like it's starting to take over.
It's a banana plant.
No, there's a vine underneath it.
Oh.
If it flowers, you can let it go a little bit longer.
That's right.
So, but we are very happy and honored to have our friend Mike Zlotnik joining us today with Tempo Growth and Tempo Opportunity Fund. We wanted to have him on because we had talked previously about the different asset classes that were affected the most through COVID. That would be hospitality, some retail stuff, and what funds that had those types of assets in them did to keep up with that class. You know, if they had to do write downs or if they wrote them back up. And just so happy to have him on here. He's one of the smartest people that I know, other than Wendy Sweet, of course.
He's also one of our favorite people. Mike is just a good friend. He's been in so many of our mastermind groups together, but we just have a great relationship, a great friendship. We have a lot of respect for each other, and he's just, he's just that guy that you're going to be buds with for the rest of your life. Mike, welcome to the show. We're glad to have you.
Yeah, and by the way, we have a lot of respect for him. I don't know if it works the other way.
Thank you, Bill. Thank you, Wendy, for having me. Absolutely. It's a two-way street. Love you both. And yeah, we've been friends for many years and share many masterminds, and happy to be here.
Excellent. Thank you
Awesome.
so much again. So, first of all, kind of give us an idea again with your opportunity fund and your growth fund. What are the asset classes that you're mostly involved in, or you're looking to put into those funds?
Sure. So Tempo Opportunity Fund has been around since 2017. It's a broadly diversified fund, and we're capital allocators. So we've been changing strategy as we go along with the best opportunities. And just a quick overview, it's got over 80 assets, broad diversifying among many strategies, including multifamily, storage, some shopping plazas, office, industrial, portfolios of single family, number of hard money loans. So this fund touches many aspects of real estate. And let me switch briefly to the Tempo Growth Fund. That fund we launched essentially just pre-COVID. We launched that fund in January 2020, and COVID hit. And it was actually a phenomenal opportunity for us, for that fund, to start picking up assets and make investments when the market was dislocated and substantially discounted. So that fund had a different mandate. That fund is a growth mandate. So it loves repositioning of assets, and we start writing a good number of checks into the hotel to multifamily conversions and some office to multifamily as that trend started to pick up quite a bit. And what's really interesting is that you can't blame everything on COVID. It's an easy excuse. Hey, it's the pandemic. The reality is that many of these assets struggled before pandemic, and kind of the pandemic knocked them out, and the highest and best use is no longer the original purpose. So it just accelerated certain trends or certain, opportunities. So that's the brief history of both funds. At this point, once we launch the Tempo Growth Fund, we start focusing Tempo Opportunity on more income deal and less of the growth deals. So
Okay,
at this point,
before you go any further, I want to make sure that we keep you and ourselves in compliance, and make mention that this is for educational purposes only. There are no sales of securities or
Your mileage may vary.
yeah. So read your prospectus, your PPMs, and again, there's risk with any investment. So continue. Sorry.
Yeah, thank you. It's a wonderful disclaimer. I like to do the same thing. Informational, educational only, and consult with your attorney and a CPA, and read the PPM, please. But so again, being capital allocated is one of the strengths. We can shift our investment focus to the best opportunities that present themselves. So as we launch Tempo Growth Fund, we obviously invest in some classic value-add multifamily projects. What has happened during COVID, a number of these projects were trading or selling at a discount. So the opportunity was to basically come in and invest in those projects at a good price. And then the hotel to multifamily, the whole trend picked up rapidly. And we, even though we're diversifying quite a bit, we're also taking advantage of some of these opportunities. So we like the strategy. We've allocated probably 40 to 50% of the funds so far into these projects. And that's been, a great blessing. The fund is still open. We continue to raise capital and continue to write more checks into the strategy, although it's getting harder to find these great deals. So during the peak of the COVID, these things were completely stalled, no business, so you could pick them up at a much better deal. Today, there's still good opportunities from the point of view that these were not good hotels pre-COVID, and now they sort of are recovering, but at the same time, they're not recovering well. So there is an opportunity to convert. And many cities and towns don't want as many hotels as they have, and they would prefer to have more affordable housing. That's why this thesis comes in. It's a do-good strategy, as well as has economic benefits to investors, because the cost to build versus the cost to redevelop is quite different, especially today.
Is that what you're seeing? A lot of these conversions happen, like a hotel. Are you seeing them go into more of a long-term housing situation, multifamily apartments and things like that? Is that what you're seeing?
Exactly. It's exactly
and
that,
then
Wendy.
What about strip centers? centers. Are strip centers in there too? And are you doing those as well?
We're not doing strip centers to multifamily. I haven't seen those projects yet. They're hard to do. Maybe zoning issues, maybe logistics. How do you do that? But the hotels, especially extended stay hotels, just think of it like a Residence Inn. It's an extended stay hotel. They look like mini apartments anyway. So they're ideal candidates. The conversion process generally easy. They may already have built-in kitchenettes. So that whole strategy seems to be easy to execute. There's two flavors of ice cream, I call it. You have the extended stay hotels, and then you have the in the good candidates area. We're not looking at the high-rise hotels. We're looking at the typically low-rise, 2-3 stories, extended stays, or your hotels that look like motels, like Ramada Inn. So you enter the instead of internal access from the building, you're entering external from those. If you can imagine these motels, what they look like. They're conversions to studios. So depending where it's located, if affordable housing is critical, instead of building one bedroom, 600 square feet, you are better off with 2 studios at 300 square feet each.
Right.
And that seems to work quite well for many people who prefer privacy instead of having a roommate.
Right. So are you also seeing any of this turn into assisted living type scenarios?
I've had a conversation with, interestingly enough, one gentleman who was talking that thesis, old hotels to assisted living. The complexity is in today's day and age, you have to build all kinds of filters, and the cost to convert are very different. So assisted living might make sense in some circumstances, but it is a lot harder lifting. It's a lot more work, more complicated. Maybe for some people, it would make good opportunities. For us, we're looking kind of for low-hanging fruit.
Gotcha.
Well, that was the question I was going to ask, and I was the reason I was asking it was because they already have the wide hallways and the elevators in place, and you would need that for people that might need to be in wheelchairs and that type of thing. So.
Yeah, not these hotels, at least not the Ramadas Inn. Maybe extended stay might have some handicap access rooms, but in general, it's not something that doesn't appeal to us, at least not as an investment strategy today.
Sure. Well,
so when you're turning them into multifamily, I'm assuming that it's more of an apartment type complex. Nobody's turning around and selling them like condos or anything, right?
Correct. Just simple multifamily, typically affordable range. As I mentioned, they're smaller units. They present probably one of the most affordable product in that zip code because there's really nothing small. I mean, either studios or small 1-bedrooms. So it's affordable product, and then they could be located in a great area. Just the demand for hotel might be subdued or wasn't there, pre-COVID. So the opportunities to convert, and the primary thesis on this is that compare building apartments ground up versus conversion. The cost to build now has skyrocketed, labor, materials. So conversion is incremental. If you pick up the right property, you may still have to put on a new roof. You may have to do some more work, but it's incrementally a whole lot cheaper than building ground up. So you can get into that apartment complex with affordable range at a well below reconstruction cost.
Now, are you doing any exterior improvements in something like that as well, making them more family friendly or?
Yeah, I mean, depending on the property, a lot of them have pools, right? So you basically have a pool for the residents at that point. Roofs, siding, some other normal renovations for an aged property takes place, and then can you build a small playground? Yeah, if it's space, you could implement what you can implement. You could also have some other hotel might have some meeting rooms or some other stuff that could be turned into rooms available for a family room or something like that. It really depends asset by asset, investment by investment.
Right. So where are you finding a majority of these? What area of the country or certain states that are doing more?
Yeah, I'm just going to go down the list of investments we've made. So there's no particular focus. It's not being done by a specific area. It's really where the opportunities show up. So we have investments in Mesa, Arizona, suburban Phoenix, kind of the workforce housing. It's they call it the armpit of Phoenix. because workforce housing.
It.
I don't know, but this is kind of what they call it. Then you got we have an investment in Longmont, Colorado. We have an investment in New Braunfels, Texas. Winston-Salem, North Carolina, sort of your neck of the woods, relatively speaking.
Yeah.
South Bend, Indiana. So they're all over the map. They're not coastal cities. They're not San Francisco's, New York's. Very different projects. These would be, high-rise hotels with very different dynamics. That's not happening here. At least I haven't seen too much of it. But funny, I have a property I'm going to go look at right before the CG Mastermind in Orlando. So we're flying in, as I mentioned, we're going to go to the Universal Studios and also going to look at a property in Orlando, one of these, hotels that look not far from Disney.
Wow.
So there's no right or wrong. It's just where the opportunities show up.
Wow.
So if you don't mind, Mike, kind of walk us through what happened with some of these properties during COVID, and then now after COVID is over with. Because your fund isn't a syndication; it's an open-ended fund. At least the income fund is, right?
Yeah. So we have the Temple Growth Fund. Just to contrast, is it's a closed-ended fund. So that fund essentially started raising capital in January 2020, right before COVID hit. And then most of our investments happened kind of after the COVID took place. And the open-ended fund is the Temple Opportunity Fund. And that fund continues to raise capital every quarter and deploy it on deals and pay distributions. So the big difference is Temple Growth has a simple mandate to acquire the assets for 2 years, put the money to work, and then let the portfolio generate the returns. Temple Opportunity is very different because it's ongoing distributions. We're focused substantially on income, just like your fund, distribute on a quarterly basis. So they have very different mandates, and these redevelopment projects fit very, very well into the Temple Growth Fund, but they're a little bit outside of the primary focus today in the Temple Opportunity. So in the Temple Opportunity Fund, what's really interesting, we've lent some money on some of these projects. We have two deals where Temple Growth took the equity position while Temple Opportunity took a debt position on the deal. Why? Because the debt generates income, and it's great for income distributions and for income-focused investment. And then on the growth side, the Temple Growth Fund is perfect for that. It doesn't need any income. It has a ton of tax efficiency, passes through passive losses to investors, but it generates the returns on the back end in the form of capital gains when these projects are converted, stabilized, and sold. So sort of those are the kind of the two differences.
I was going to say, if the sponsor decides not to sell and to refinance and then cash everybody out, then that transaction may have some additional tax benefits with it to the investors as well, right?
Yeah, for sure. So part of the strategy on a lot of these deals, there's two primary strategies. Think about this on pretty much any value add project. You have the value add phase, and which is a conversion of a hotel to multifamily or whatever it is on existing multifamily renovations. Once that completes, the sponsor typically either sells it outright, which is just call it 2 to 3 year flip, or strategy number 2, refinance, return substantial amount of capital, and hold it for, say, 5-year hold. So we welcome both. In either scenario, it works for us. If it's a refi, it's a return of capital tax-free completely, which is always welcome, right? Mm-hmm. And on the other side, if it's a sale event that happens fast, it typically increases the annualized return. The IRR, internal rate of return, goes through the roof. So we welcome either strategy works. Most of these deals are underwritten for a 5-year hold, but some of them will immediately say, "Hey, we're gonna value add and then sell immediately." So it works for us. We actually like both of these strategies in the fund. Why? Because we want some assets to flip in 2 years, some in 3, some in 4, and some in 5. We don't want everything to come out on the back end, because investors ask us, when am I going to see some money back? Well, you're going to see some money back earlier because some stuff will flip. So that you could do that in a fund. It's harder to do with one-off deals because you get all or not. Whatever happens in that deal, that's what you get.
Right.
Right.
That's awesome.
So let's talk about the values of some of these deals during COVID and then after COVID. And I'm not sure which fund exactly, but this happens even in syndications where you're doing a value add project, and as your income is much less because you don't have as much occupancy because you're fixing them up, the values of the properties actually go down during the investment, and then in later years, as you start increasing the occupancy level and the income on them, then those values go back up again. So the writing down and the writing back up again of an asset is pretty normal anyway, isn't it?
Yeah, that's right. So that's a great point. I'm going to make a couple of quick comments. So the beauty of a closed-ended fund, we don't really care about write-ups and write-downs. We don't have to do quarterly mark-to-market. In an open-ended fund, we do that. So for Tempo Opportunity Fund, this matters. For Tempo Growth, it doesn't. But from the valuation perspective, you're absolutely right. If you have a functional hotel and then you stop operating it, the value has dropped, and then you convert it, restabilized, then the value has gone up. Pardon me. So what we just observe, we call that the returns in these value add projects follow what is known as the J curve. Imagine letter J. So in the beginning, the value of your investment drops like a letter J. Literally, just draw letter J, and then as you execute the value add strategy, the returns start picking up. The value investors picks up quite a bit on the back end. This J curve is an incredibly powerful strategy because you can, without giving any investment advice, not a CPA, don't play one on TV, informational purposes only, usual disclaimer. You can invest traditional IRA money into a growth fund like Tempo Growth Fund or a growth value add single deal, and then convert it at the bottom of the J curve when the hotel stopped operating, and now is this functional hotel being converted to multifamily and converted at a valuation substantially lower than what you put in the cash. It's a pretty powerful idea. I'm a little bit tangenting from this, but you started on this point. I wanted to share this idea. So if it makes sense for people, you can write a $100K check in the middle of the value add. It's worth $70,000. You convert, you pay less taxes in the conversion value. That's the kind of concept here. For an open-ended fund, now I'm going to use another example. For Tempo Opportunity Fund, we invested in May 2019 in a hotel conversion in Ogden, Utah. Now, this was not one of these residence inns nor Ramadas. This was a boutique hotel, kind of a high-riser. This was a pre-COVID outburn, and it was being converted to apartments as well. What's really fascinating on that project was that it gave us a lot of passive losses, and we had to basically mark down the value of the investment on the books of the fund while it was being converted. Now, the project just sold, well, not just, but it sold in February of 2021, this year. And it sold at a phenomenal price. Essentially, we generated 2.2 times return on the money in 21 months.
Wow.
Yeah, it sold, like you asked me the question, what has happened with all these values? And the values shoot up. The pro forma projection on that sale was 18.8 million. It sold for over 20 and a half. So when you have leverage deal and these properties come out of the COVID and they come out strong and they sell above the target price, it magnifies rate of return quite a bit. So we saw that. So that project, we just finished Q1 again. Full disclaimer, we're about to finish the results, and the Q1 has a monstrous results, much stronger than our typical quarter because that asset sold at a rate of return far above the projected number. So we're having massive distributions in Q1 as a result of this. So when they happen, these projects, they pop. When they pop, the returns shoot through the roof, and that's what happens on these projects. You have to be patient and deal with a markdown until it's going to the project. But when it exits, and it exits well, it becomes a home run.
Well, too, Mike, I think it's really important that we mention here, this is the perfect scenario of why it is important to know, like, and trust your fund manager. You have you have to trust in Mike's knowledge, ability, skill level, ability to see into the future, ability to make sure that all of your exit strategies are a win-win. It's just amazing how you have taken what some people would have looked at as a complete and total lemon and turned it into not only lemonade, but lemon everything. Because it's sweet. It's absolutely sweet the way all of this turned out. But you have to trust your fund manager and pick a fund manager that understands what they're doing. You've done a phenomenal job.
Thank you, Wendy. You're so sweet.
That's why they call me Wendy Sweet.
That's right. Yeah, I greatly appreciate the kind word. It's exactly the case. The same goes for you. If you don't know, like, and trust, we use the same philosophy in our investing. We can't write a check until we know, like, and trust whoever we invest with. And the same is true. So that is given. The other quick question, I don't have insight into the future. As I like to call it, I had a great crystal ball. It broke. I can't find another one for sale.
And the blessing of God.
Yes, and the blessing of God. But I think that you could ask for, you could pray for, but the crystal ball is going to be hard to find.
That's right.
You can absolutely see the trends and understand, identify the opportunities. And the investing is not an easy game. It's definitely something I love to do. This is kind of my genius zone. And I mean, we saw that to be one of the strong, COVID created opportunities. It's not necessarily all COVID, but it is one of the substantial ones. The other thing you talked about is the shopping plazas, and I can tell you this on the shopping plazas. So during COVID, we had to write them down in our Temp Opportunity Fund. When the thing started, we had no idea, especially Q1 and Q2, 2020, things look very scary. Mm-hmm. I mean, people are going to be in this funk for a long time, right? And then as things started to come out, we started writing it up. That's one of the things that fund managers do, like myself, in an open-ended fund. You write things up and down as market conditions change or assets go through their progress. It's something that is both a beauty and a curse. Right now, things are looking great, but during COVID, man, I had to explain to investors why the returns are not looking great because people. One thing that most investors misunderstand. They look at investments as bright and shiny objects. They don't understand investment can have a downside.
Right.
Things can go down. So if you're just investing for upside and you want safety guaranteed, you got two options, right? Buy government bonds and get your whatever little return, or call Bernie Madoff. He'll guarantee you, he'll pay you like a clockwork, and you'll be paid until the whole thing will stop. But most of other investments have some degree of risk. And investors should understand, you don't always have perfect smooth sailing. You will have ups and downs, especially when black swan events like COVID hit.
Right.
You have to understand things may be a little rocky for a bit. When the storm passes, you may have a great smooth sailing from there.
So the bottom line is that there is no straight line in nature. And when you invest in a fund, you're not doing it for the next 6 months. You're doing it for the next 5, 6, 7 years. Investing in a fund is not a short-term thing. And you're going to have some ups, you're going to have some downs, but you have to trust that your fund manager and the investment strategy that they're employing is a long-term win situation. And you're always going to have black swans that are going to affect this. But if your strategy is sound over time, you're still going to be on the upside.
Yeah, that's the words of the wise. I agree with you 100%. Most people don't quite understand this concept. They think, hey, I'm just going to invest in any open-ended fund, and when I want out, I just click a button like you sell stock. It doesn't quite work like this. You're really investing for long term.
Right.
That's the whole idea. These alternative investments, and that's what we call them. They call alternative investments to the stock market. One thing you're sacrificing is some of that liquidity, and you're parking the money for somewhat of a longer term. So if you take that to heart and you understand that, then you wind up not being disappointed, because sometimes you will have COVID. Unfortunately, this is how the world operates. And the shortest distance between two lines on a planet of Earth is not a straight line. It's a curve. And sometimes you have to walk the curve.
Yeah,
So,
absolutely. Mike, how can people get a hold of you?
thank you, Billy. It's cheesy, but it's you can see it bigmikefund.com. This is the easiest way to remember. As always, I correct this joke because it has happened once, and I realize there is some wisdom to this. So go to bigmikefund.com, and if you misspell it, you forget the D at the end. I promise it's not a kinky site.
Well, my head wasn't going there, but now it is. Thank you.
Well,
what happened was that because I'm not a native speaker, I wasn't born in this country, and maybe the D I was kind of mispronouncing it. I was on a podcast with somebody. It was on my podcast. We were exchanging information. I think I was a guest on another podcast, and they asked me how people can get a hold of you. I said bigmikefund.com, and the D was silent. As a result of that, they said, "Really, you got that site for your name is Hurt." The moment I realized I misheard, I ran immediately to GoDaddy. Let's grab the domain and let's forward it to a good site, because somebody else could have something else inappropriate on that domain.
Funny. That is too funny.
Real world.
That's right.
Thank you so much for spending some time with us, my
Yeah,
friend.
Thank you, guys.
I hope I will see you in a couple of weeks here, and we'll be down in sunny, hot Florida.
Yeah, see you there. Coming, absolutely.
Folks, thank you so much for joining us on the Passive Accredited Investor Show. I'm sure that you got a lot out of this. Mike's very intelligent and analytical, and he explains things very well. We are Carolina Capital Management. We are lenders for the Southeast for real estate investors. If you are interested in borrowing money, go to carolinahardmoney.com and click on the Apply Now tab. If you're a passive investor looking for passive returns, then click on the Accredited Investor tab. Don't forget to like, share, and subscribe. Hit the bell, all that good stuff. And lastly, Wednesday with Wendy. Go ahead and like I said, she's usually booked out about 2 months in advance. So log on to her calendar and get your 30-minute spot free of charge.
That's
before
right.
she starts charging. The more time she spends with the banana trees in the background, the more likely she is to charge. Anyway, thank you guys so much for joining us. Have a great week. We'll see you next week.
Thanks.